All right. So I'm in a room full of people who are probably wondering, why should I trust you? High net worth or family offices have a legitimate question to ask in that regard. When I sold my company a few companies ago and came into, it was a deal that started with us on credit cards and living in a low-income housing project and dumpster diving for furniture. 18 months later, we were on our way to an exit that I nixed, much to the chagrin of my team. But 18 months after that, we closed on $580 million. And I had a number of people then that I didn't know I had as relatives or long lost friends, or who needed financing for one or another brainstorm that they had, ex-buddies from business school or my CPA tenure at one of the big firms. And so I'm standing here in front of everyone and on the camera to say, I know where you're coming from if you're skeptical. I've been there and I've been burned. I've been most recently, this was with a business partner, unexpectedly, that went south and involved some pretty bad consequences for that guy, but led me to wonder whether or not I have issues in terms of giving away my trust or imparting trust into another person too readily. And that's the genesis of trust science that I'm going to talk to you about now. It was to, as a technology commercialization guy all my life, all my career, trust science is in existence to predict what another person is going to do. So the science of trustworthiness is just a fancy way of saying that. What's a human being going to do in a given circumstance? And with that, I plowed a lot of resources, time and money into building this as a platform in that generic sense. So not specific to the credit use case that I'm now going to describe to you. The credit use case is just my first go-to-market. I want everyone to be clear about that, because the rest of the presentation is very, very deliberately, hyper-narrowly laser-focused on predicting what a person is going to do if you give them money. And if you're a lender, who are my customers, will you get your money back? Key question. All right. So with that, I'm going to share the screen here and get this. Yep. See if I can get that a little bigger. Not necessarily. Oh, there we go. All right. So Credit Bureau 2.0 is the name of the service that Trust Science offers right now, the first of our planned many number of other services, which I'll talk about in a second. And our mission as a company is to allow deserving people to get what they deserve. My go-to-market, as I've just mentioned, is to fairly and ethically score financially stressed consumers for global lenders. Myself, or by background, I'm a CPA and I got my law degree at Columbia. I'm raised on a farm. The cowboy hat doesn't travel very well, so I'm not wearing it right now, but you can find pictures online with me in that. And we were raised to leave the world better than you found it. I've, in a career of doing this kind of work, which is creating new categories or wildly disrupting old ones with technology, I've delivered realized gains to my shareholders, now totaling over $500 million. I think that trust science is the biggest thing that I've ever done, for reasons that I hope you see and sense for yourselves. I'm now in the middle of bringing in patient capital from families or anyone who's either familiar with technology commercialization and or is deeply familiar with the industry that I'm serving right now. It's important to me to have strategic people and people who are of a mind to be involved in something that's got a pretty healthy ESG component to it. The deserving people that we're referring to, or that we're helping our lenders score, is the bottom half of the economy. Or so-called bottom, the so-called subprime or non-prime consumer who is either new to the country or new to credit or self-employed or for other reasons is not seen in the conventional sector. But these people have never been scored properly by the conventional systems and methods for reasons that these conventional systems and methods were invented in the 1950s or got their start in the mid-1900s. And you don't kill the goose that lays the golden egg. You're still, many of you probably in this room are being scored on mainframes or with older style technology and algorithms. It is computerized. I'm not saying that it's not. I'm just saying that it's slow, and the evidence that we see every day as Trust Science helping our lenders is very apparent when you put us in a horse race or a bake-off against our competitors. Competitors, just so that you can frame what I'm talking about, would be if you could marry the following three things in one service offering, that would be a direct competitor. So the indirect competitors are FICO or Vantage. If you married those with Equifax, Experian, or TransUnion. And then thirdly, so those are two classes of things. The FICOs and Vantages are the scoring or algorithms people. Equifax, Experian, and TransUnion are the data folks. And then the Proveneurs of the world are the decision engines, or the, besides the score, besides generating the score that FICO gives you, you then have to apply rules and strategy that are reflecting your particular lending institution's approach to the market. So if you could automate those rules and decisions, you'd essentially have a virtual loans officer, which is part of our functionality. So if you had all those three things together, you too could find the invisible primes, as we call them. That's the subprime folks, that bottom half of the market, who are wrongly scored as subprime. These are the people who would rather lose their left arm than welch on a debt. These are the folks that are not getting an on-ramp into the modern economy because either the score is too low or the decisioning is flawed about them. This is a problem that affects hundreds of millions of people. These you'll hear the term credit invisibles or thin files. That refers to thin not having terribly much data. The size of that market is 20 million or more consumers in the US. That was before the pandemic and everything that's happened in the meantime with interest rates and inflation. It's now said to be 50 million and growing. And the World Bank indicates that worldwide, this is an issue that's measured in the billions of people. We were awarded last year a Global Impact 200 award. There were 200 companies, only 18 of us that were technology companies. I was proud to see us sitting alongside of the Microsofts and the Teslas of the world in that 18 company list. Oops. And the solution here is two parts. It's the three competitors or three classes of competitor I mentioned, but our way of doing that is both a big data solution as well as very heavily and deliberately focused on AI. And you couldn't do the kind of work I'm doing if you were not 100% AI-based and capable of ingesting vast amounts of data. This is a problem that is otherwise impossible to solve for reasons that the so-called have-nots, or the bottom half of the economy, look and behave like, data-wise, they look very different than the prime and the super prime parts of the economy. So the old systems and methods are really okay at, roughly okay at separating amongst the prime and super prime. The minute you start getting below a score of 700, which is that bottom half, you're not going to get very far without AI and big data. Yes, Marty?
Can you define alternative data? Are you looking like through text messages and emails, or?
Yeah, for those online, if you can't hear the question, Marty just asked if I could define alternative data, and that's various classes of different data. We involve the consumer, because what we're doing is compliant with all the relevant regulations. In this case, that would be the FCRA and ECOA. So alternative data involves things that the consumers consent to give us, that we then go and get from either their financial institution or other of their sources that they're allowing us to look in on. That consent is really important for me to stay compliant or stay out of FCRA jail. And we are also availing ourselves of sources of data that do exist in the government or public records on everyone or on many people. If you're a returning customer, we're going to get the data that, if you're a returning borrower, we're going to get the data that our customer, the lender, already has about you. So there's legacy data with you in terms of your prior behavior and so on. And then there's the conventional bureaus. We're not allergic to their data. We just know how to squeeze more juice out of those lemons. Marty has another question.
So historically, there's been a lot of questions with emerging market lenders and micro lenders. And so is your model applicable to that? I mean, so what great example is that? In India, somebody was doing a lot of micro lending. They lent like $20 million, and they found out lending to women, the payback rate was far higher than lending to men. That happened in India, right? And that was 10 years ago. Do you uncover data like that, or do you put that into your model?
So Marty was asking about emerging markets and micro lending. Yes, we can. We're built as a platform that's global. I'll talk a little bit more about that in terms of having gained patents, applied for, and now having earned patents in 13 or 14 countries, over a dozen. So we are aggressively prepared as a platform to go into the emerging markets. But for now, we're focused right in the US and Canada, North America. Mexico will be next. Right. This is a busy slide. You can come to see me or, on my laptop, or grab a screenshot of that for yourself. This is talking about some of the other players in the space. The axes are data, how structured or unstructured it is, and technology, how modern or old school it is. We put ourselves in the top right-hand quadrant for lots of reasons that have been proven in the market now. Some of those names on that diagram we are beating in head-to-head competitions in competitive settings. Our customers are boring. I say that lovingly, especially in the era that started 5 days ago. These are either publicly traded consumer finance companies, or more recently, some of the banks that are on the GSIBs list, the Global Systemically Important Banks list, 30 biggest banks in the world. Some of them are private and some of them are publicly traded. What we are focusing on right now, in addition to lending, is only automobile and consumer lending. So while the platform is not restricted in that way, and it's not even restricted to lending, there's a superpower or a compounding of data magic that happens if you're focused in a particular subsector. So we've really narrowed down into lending to lenders in consumer finance and automobile lending. And since we came to market, legally being able to offer the first score for the first time in 2019, just before everything melted down, our customer size has expanded dramatically. We were dealing with essentially startups or people whose businesses had started in their dorm room, and we're just beyond that point in 2019 to now 2022, 2023, as I said, dealing with some of the GSIBs. The growth in revenue has also been similarly explosive. The frightening and exciting part about explosive growth is that it's explosively expensive, which is why I'm here raising money. The logos that you see there on both sides of the Canada-US border, and the first 2/3 of that chart are actual revenues in the last 2 years out of 6 are what we expect is going to happen this year and next year. In Canada, the equivalent of the Wall Street Journal is called the Globe and Mail. They evaluated the active companies in Canada, of which there are 4 million. We were number 20 fastest growing. That's all sectors considered, not just a technology thing. I can't predict exactly because I don't know what all the other companies are doing, but this year we are almost certainly we will certainly be on that list again this year, and maybe even higher ranked than the spot number 20 that we were in 2022. Speaking of GSIBs, after what was characterized by the previous speaker as a proctological exam, we went through having more orifices than I knew I had examined by TD to allow their global head of innovation to join my board of advisors. And so we're very proud, and it's been a fantastic door opener and lots of insights on our execution being offered by Imran Khan. Other things is that we're blindingly capital efficient. We do not have any institutional investors by design. Thank God, given what the VCs have been doing to their investees over the last year or so, 8 or 10 months. And again, as I said at the outset, I'm seeking investment from patient folks who have a longer horizon, know something about the space I'm serving as in terms of lenders, and or know something about technology commercialization on the ground or for real. This is not something that would make a great investment if you're looking to flip it in X number of weeks. We're now approaching cash flow break even. I have the simplest cap table on the planet because of what I just mentioned. So everyone has come into a Class B of common shares, and it's a one-page subscription agreement. So no lawyers have gotten rich on these financings. I've raised a total of $20 million to date. The other thing besides that background is that in our execution, we are fanatically attentive to, and bullet point number 2 here is security. That's our Chief Information and Privacy Officer, Security and Privacy Officer. He reports directly to me, not somewhere else inside of technology or anything like that. And on the patents that I mentioned earlier, they're not just wallpaper or decorations. We've used a couple of them now successfully in offense here in the US to shut down wannabe competitors. Yes, Marty?
We have a little bit less than 5 minutes, but I have a question from the audience. Are you in the deep subprime space, 575 and below? And do you look at consumer direct loan credit without collateral?
The question was, are we in deep subprime? And do we look at unsecured consumer lending? And the answer is yes to both. We're in as far down in the stack or the credit quality ladder as measured by FICO. That reference to a score of 500 and something was a FICO concept. You may find that our what we call the SIX score, SIX score, it would actually treat them as if they were a 750 or an 800. It's not that I show up and suddenly everyone's scores are inflated. Deserving people are what we're focused on, and that may mean that some people who are high scored by FICO shouldn't be. They've figured out how to game the system. You can go on YouTube right now and find 100 ways. Given that the conventional system I'm competing with is decades old, it's easier to have figured out the cheats or the hacks. Anyway, yes, the answer to the question is yes on unsecured consumer loans, no collateral is our one specialty, and our second one is automobile lending.
So I'm thinking there's a lot of financial modeling around this, right? I mean, like, I don't understand why you can't kind of like white label this almost as like an index, sell it to credit companies who want specialty credit indexes or credit ratings on a particular pool of vehicles. Like, I'm thinking like widows, orphans with wealthy grandparents, stuff
100%.
Like that.
Marty was asking about using this on pools or bulk scoring or creating an index, and we are absolutely capable of doing that. We call that the bulk scoring. piece of or service. And in that vein, we're talking to the buyers of books of loans. So the securitization folks on the other side of the originators in cases are our clients. So they're running through 500,000 or 1 million loans that have been originated and are in payment. And we'll look at the quality of those to give you another bead on whether or not the quality is as indicated by the FICO scores. I have a proven team of leaders, not enough time to get into each one of them, but very quickly, and as a fun fact, if you or anyone in your family has a problem with Netflix and addiction, may I say, my CTO was the guy on point for the creation, the spin up, and the early incubation of the electronic version of Netflix when they were just cutting away from being physical media in the U.S. Postal Service. So talking in terms of scale, talking in terms of security, talking in terms of rapid adoption, our architecture and our system is in very good hands. Question, yep. The question is, what do we see regarding dark clouds in the current environment, inflation and recession? The answer is we're the canary in the coal mine. We're seeing it now. We started seeing it earlier than everyone else, and so did our clients, because we're able to refresh that data and those models in real time, near real time, given that I took the effort to build this as a legitimate machine learning platform. And so I'm getting the cane off the stage right here. These are some of the advisors or other high net worth people who are in the company. The top right-hand corner is the person they refer to as Seattle's unicorn whisperer. He has come in and quintupled down on his investment not too long ago after watching us as an insider for a couple of years on the execution. Don in the bottom left corner used to run $1 trillion of AUM as the CEO of Manulife, parent company of John Hancock. And in summary, I'm raising 6 or 7 figures from high net worth individuals. I have a proven team. We know what we're doing, very, very fast moving. It's a massive addressable market and growing, especially now. And the use of funds is not for, there's no technology to build or mysteries around whether or not we know what we're doing or does the market want this. Mostly the use of funds is sales, marketing, customer success, and customer implementations. And we have big, huge moats. I touched on this being a regulatory, heavily regulated undertaking. That's a moat in and of itself, is that we have absolutely paid close attention to that. We're not a bunch of snot-nosed kids freshly minted with some kind of a degree trying to move fast and break things. We're serving GSIBs, and so besides the regulatory compliance, there are the patents that I've already spoken to. And we don't have time for this clip, but if you saw it or you want to see it, politics aside, the Vice President is making a very, very compelling and impassioned case for the fact that the bottom half of the market is not the bottom per se. These are good people who are just getting scored really poorly and not getting that chance.
Absolutely. Thanks so much, Evan. Great job.